Imagine you have $1,000 to invest. You have two choices. Option 1, buy shares of a single company. Option 2, buy a fund that owns hundreds of companies. Which option gives you the better chance of building wealth? Today, we're breaking down one of the biggest investing debates: index funds versus individual stocks. If you're new to investing, you've probably heard these two terms a lot. Some investors swear by index funds. Others prefer picking individual stocks. Both can make money. Both have risks. But they work very differently. Let's start by understanding what each one actually is. What are individual stocks? When you buy an individual stock, you're buying ownership in a single company. For example, if you buy shares of Apple, you're betting that Apple will continue growing and becoming more valuable. If Apple succeeds, your investment can grow significantly. But if Apple struggles, your investment can lose value. This means your success depends heavily on the performance of one company. That's both the opportunity and the risk. What is an index fund? Now let's talk about index funds. An index fund is a collection of many stocks bundled together. Instead of buying one company, you're buying small pieces of dozens or even hundreds of companies. For example, an S&P 500 index fund owns shares in hundreds of America's largest companies. If one company performs badly, the others can help balance things out. This reduces risk. Think of it this way: buying one stock is like betting on one player. Buying an index fund is like owning an entire team. Risk versus reward. This is where the biggest difference appears. Individual stocks, pros, higher potential returns, opportunity to beat the market. Cons, higher risk requires research. One bad investment can hurt your portfolio. Index funds. Pros, diversification, lower risk, easier for beginners, less time required. Cons, usually won't outperform the best individual stocks. In simple terms, individual stocks can make you richer faster, but they can also lose money faster. Index funds grow slower, but are generally more stable. What do most successful investors recommend? Here's something interesting. Many of the world's greatest investors recommend index funds for beginners. Why? Because most people don't have the time, knowledge, or interest to analyze companies every day. Index funds allow investors to benefit from the overall growth of the market. Even legendary investor Warren Buffett has often suggested that average investors consider low-cost index funds. Why? Because simplicity often beats complexity. Many people try to beat the market. Very few consistently succeed. Which one should you choose? So which is better? The answer depends on you. If you enjoy researching businesses and understanding financial reports, individual stocks may be worth exploring. But if you want a simple, long-term strategy, index funds are often the easier choice. Many investors actually use both. They keep most of their money in index funds and use a smaller portion to invest in individual stocks. The biggest mistake isn't choosing the wrong investment. The biggest mistake is never investing at all. Whether you choose index funds or individual stocks, the most important thing is getting started and staying consistent. Tell me in the comments, would you rather own one company or hundreds of companies? And don't forget to subscribe for more investing and financial education videos.